Good day, Junior Tikkies. I'm Mrs. Brimacombe, and we are going to look at adjustments. We're going to look at interest on loan. It is important to understand, first of all, that interest on loan is a financing expense. That is the cost of borrowing money. Now, it's very important to take note of the following. Interest can either be capitalized or not capitalized. So if we first look at what happens if it's not capitalized. If it's not capitalized, it means that my interest on loan, which is an expense, is going to be debited. That will have a negative effect on the owner's equity. If the interest is paid, it means bank is credited. Now, if we have a favorable bank balance, it means it will be subtracted from your cash and cash equivalents. If we have an unfavorable bank balance, it will still be credited, but now it will be added to your bank overdraft in current liabilities. At the end of the accounting period, if interest is still outstanding, it needs to form part of my expense for this accounting period, so we need to make an adjustment. We need to account for that expense, and if that happens, it means interest on loan is still debited, but now accrued expense is going to be credited, and that will increase your liabilities. If we look at if interest is capitalized, it means that interest on loan is debited, owner's equity will decrease, and my loan account is credited, liabilities will increase. So what do both of them have in common? Interest on loan is debited. The rest is going to be credited. So it all depends on if interest is capitalized or if interest is not capitalized. Looking at activity 15, show the effect on the accounting equation and indicate how it will appear in your financial statements. So they provided you with a loan statement, the balance in the beginning, monthly repayments, interest on loan, and the balance at the end. Calculate the amount of interest paid during the financial year. So this is clear that interest is capitalized. Now, if you're not sure how to do it directly from the statement, you can open up a T account and we fill in the information which we've got. Balance in the beginning, 120,000. The total repayment, including the interest for this accounting period, which means I have to take 1,900 times 12, equals 22,800. Interest on loan is always added to the loan account if it's capitalized, which is a question mark. We need to solve it. So now they provided me with the balance at the end, 108,000. Now interest on loan becomes the balancing figure. We take the debit side minus the credit side, and that equals the interest on loan. If you were to do it directly on the loan statement, we have to work from the bottom up. It will be 108,000 plus the total repayment for 12 months minus the 120,000, the balance in the beginning. If loan is credited, it means interest on loan will be debited. Completing this on the accounting equation in my income statement, and the effect on the accounting equation, owner's equity minus liabilities plus. My total interest for this year is 10,800. It will appear in note number 2, interest expense. The interest on loan is 10,800. Balance sheet, non-current liabilities. Please take note what I've done. I took 97,200 from the pre-adjustment trial balance and I added the interest. If you take 120,000, the balance in the beginning, minus the total repayment 22,800, it equals the amount in the pre-adjustment trial balance. So what have they not done yet is added the interest. Activity 16, again, show the effect on the accounting equation and indicate how it will appear in your financial statements. Adjustment. The loan agreement stipulates that installment of $20,000 will be paid annually on 31 August. Interest must be adjusted. So this means I need to find out what was my total interest for this accounting period to find out if there's anything outstanding. I cannot just take 120,000 times 8.5% because annually on the 31st of August, 20,000 is repaid. So if I draw this on a timeline, it means that the balance from the pre-adjustment trial balance, 120,000, is after the 31st of August. Now you need to remember it's a payment, which means the balance in the beginning, we need to add the 20,000 to the 120 to find the balance in the beginning. Now, for 6 months, we need to work out the interest on 140,000 and for 6 months on 120,000. So my total interest added together will appear in my interest on loan account. So if I open up interest on loan, we start with the total brought forward from the pre-adjustment trial balance. Our total interest for this accounting period should be 11,050. So it's clear that there's a difference of 4,060, which is still outstanding, which means accrued expense is going to be credited. To show the effect on the accounting equation, owner's equity minus liabilities plus. In my income statement, interest expense, note number 2, 11,050. If they didn't ask you the note, it will appear on the income statement as part of interest expense. And the balance sheet, non-current liabilities is going to be 120,000 minus 20,000. Why am I subtracting 20,000? If we pay annually 20,000, it means whatever we pay in the next financial year must be subtracted from the non-current and taken to current liabilities as current portion of loan. If I add those two together, the non-current plus the current, it still equals the 120,000. Make sure that you understand the current portion of loan. Whatever is paid in the next financial year must go to a short-term loan. It's another word for it. Thank you very much. I want to leave you with this quote. Don't let what you cannot do interfere what you can do. In our next activity, we are going to focus now on interest on fixed deposit. Hope you have a wonderful day.